bulls or the bears, but the hawks that are hovering around world markets, with Asian economies hiking interest rates and the ECB expected to hike rates tomorrow. The Federal Reserve has been divided on whether to tighten its easy money policy, but the decision doesn't come easy. Joining us live is Al Brodus, former president of the Richmond Fed at Richmond, Virginia.
All right, Al, let's go straight and to you and chat with you what we can expect now with the ECB expected to hike rates tomorrow. Is this, you think, putting pressure on the Fed, perhaps?
I wouldn't say pressure, really, and certainly if there is pressure, it wouldn't be great. But there's no question that we live in a global economy, and we live in global financial markets, obviously now. So the fact that the ECB is doing this, it is, I think, in the light of recent European inflation data, it is clearly a move to ensure the credibility of the ECB's anti-inflation policy, and that's a context that will be helpful, I think, to those in the Fed who want to make sure the Fed does not fall behind the curve if, in fact, inflation pressures begin to grow. So not a lot of really direct, immediate pressure, but a context that I think could be quite constructive as we go forward for the Fed.
But Al, what kind of a signal does it send from Europe?
Well, it's not purely domestic, but I think primarily in this kind of environment, the Fed still focuses and gives greater weight to domestic conditions. But they're well aware of what's going on elsewhere. There's no question about that, and that will factor in. Again, I think the impacts of something like the anticipated ECB move tend to be at the margin, but over time they can accumulate, and we'll just have to see how that goes.
Okay, so Al, what's your sense? When do you think the Fed will end quantitative easing to, and what factors will it really be watching out for?
Still, one can certainly see a set of circumstances where that might happen, but I think it's up in the air. I think the range of possible dates would be anywhere from towards the end of this year, and there are a couple of FOMC members who have said that's possible, to as long out in the future as 2013. And I hate to say it this way, but it's going to depend on evolving circumstances. Inflation at the moment and inflation expectations seem to be well anchored, well under control, despite the spike in commodity prices. I'm talking about core inflation here. But there are a few signs, if you look at that data really closely, of some small pressure beginning to develop. If that continues, then the date will be sooner. If it doesn't, then it will be later. They're going to look at the data.